Today, Fasken and Alberta Innovates are happy to partner to bring this to you, preparing for capital raising success. I'll tell you a little bit about Alberta Innovates first, and I'll hand it off to Chris to speak about Fasken. So Alberta Innovates is a provincial crown corporation. Our intention is to help with innovation in the province of Alberta, and we do that in a number of ways. So we help with basic research at post-secondary institutions. We fund entrepreneurial enterprises in Alberta, so tech startups often come through us for funding for growth. We have our executive business advisor program that provides in-depth coaching and support on an ongoing basis, which is free for scale-up stage tech entrepreneurs. And we also have advanced research. So that is research for larger organizations that are hoping to fix big problems using research and development. So with that, I'm happy to have you all here. Thank you for joining us. I will pass it off to Chris at Fasken and let him begin going through our content for today.
Thanks, Dana. It's Chris Wolfenberg. I'm a partner with Fasken. We're a law firm countrywide. We've got offices in Europe and South Africa as well. Our focus in Calgary is really on the tech side. We've got a litigation practice, but we've also got a corporate practice, and we do anything from startup all the way up to significant public M&A. I run our startup program here in Calgary, and I've done that for the last 5 years or so. I've been practicing law for 20 years, called to the bar. Actually practicing law, probably about 10 of those years, and the last 10 have been spent more on an advisory capacity, both to startups, but also to growing enterprises. And when I say actually practicing law, what we're going to be talking about today is more common sense than it is law. And so when the topic first came up, I thought we've got to have something memorable. I'm not memorable, so the content has to be. And so the theme today is the 5 Ps. And if you take away anything from today's session, it's making sure you've got the right process in place, that your price is right, that you've got the right practice, that you've got the right people, and that you're actually able to perform. So those are the 5 Ps. Fasken itself has been around for a very long time. In Calgary, about 15 years. We've got a number of, especially AI clients up in Edmonton, and are exploring space up there. So we're growing, and really part of our effort to support the ecosystem here involved, not just sponsorships, and we're kind of moving away from that and more into actually integrating with the ecosystem. And the biggest way we thought we could do that was by bringing on an entrepreneur who could, in the very same way Alberta Innovates, supports folks, is by giving advice, business advice that comes from someone who's been there. And so we brought on Chris Buckman 2 weeks before the pandemic started. So he hasn't even met everyone in the office yet because our office was closed. Starting to reopen slowly now, and Chris, so he is still integrating with Fasken, but has been out there. We ran a Zoom call in the first week where the shutdown occurred, trying to support local entrepreneurs. And since then, he's continued to reach out, develop relationships, and has supported the ecosystem. His advice is free as well. And so we've worked really hard to make sure that he's got the tools he needs to do that. And I would encourage everybody on the call to reach out to him afterwards to connect. So I'll pass it over to Chris. I'll let him introduce himself, and then I'll get into a little bit about myself before we actually jump right into the subject matter.
Pleasure to meet everybody. Thanks, Chris. Just a pleasure here to be speaking with the group today, and I do welcome the opportunity to connect afterwards. So we'll make sure through Alberta Innovates that we get my contact info out to the group. Again, I feel very grateful and fortunate to have sat many sides of the table, but more or less both sides of the table as an entrepreneur and also as a venture capitalist. So I understand the pain, the pinch points as an entrepreneur, but also the detail, the sophistication, and some of the conversations that happen inside of a venture capital firm. I'm very fortunate to work with Alberta Innovates as an executive business advisor as well. So I see a few familiar names here popping up on the screen. That's great to see. Again, I'm a life learner, so I learn from the entrepreneurs just as much as I can share some of my insights. And it's really, honestly, it's Chris and I have known each other for a decade, and he was very supportive of me with my first transaction, real transaction, and just a life learner. Continue to learn from you and from people like Chris and Fasken and Dana. So really look forward to the conversation, and we will open it up to Q&A after a few key points here, but I'll pass it back to Chris.
Thanks. It's like the Chris show.
Yeah, on the couch.
Unlike Chris, I'm not a life learner. I keep making the same mistakes over and over again, and I keep seeing the same mistakes made over and over again. I operate at a pretty low level, and so taking advantage of others' mistakes and even my own mistakes, because I will get involved with clients from time to time, either at a board level or as a founder. The mistakes people make are really what today is all about, and trying to learn from those so that you're prepped and you can jump ahead a couple of steps when you're getting ready to do a raise. And I'm going to assume, for purposes of today's presentation, that this is your seed round and or your Series A. We're not going to talk about follow-on rounds, although all of these rules would still apply. So in terms of the 5 Ps, the first thing I want to talk about is process, and a failure to understand the process. So you've got a pitch deck, you're doing your elevator pitches, you need some money, you're not sure where it's going to come from, and so you're trying to get the message out as widely as possible, or maybe it's even on a targeted basis. But not understanding the process is really going to affect your ability to move through that process. The process is dynamic, so there's no set path. You might get some angel money, you might get some early stage VC money, you might just be looking at friends and family. You don't know where the money's going to come from, but if you don't know the process, you can't possibly follow a path that will ultimately bring you success. And so it's really understanding where you're at in the process, what the process looks like, who the players are in the process, that will allow you to have the confidence to be able to pitch to the right people at the right time and get the right results. So when I talk about process, what I mean is understanding what your needs are, where that funding has to come from, how much funding you're going to need in order to achieve number 5 is performance. We'll talk about that in a little bit. But understanding the process. So your friends and family round, you're not going to have sophisticated documentation, likely. You're also not really going to have anyone asking you hard questions. Your friends and family might ask a few questions about a product or a piece of software. They're not actually going to drill down, do much due diligence. They're not going to run you through the process. And that is a bit of a disappointment, because although they're your cheerleaders and your supporters, they're not helping you with anything other than a check. They're not getting you ready for answering the hard questions that are going to come. So process itself, first engagement, introduction. Those introductions are going to come through networking primarily, referral. So use your advisors, whether it's an accountant, lawyer, whoever it is, ask them, because they will know who has been through that process before. Who should I be seeking out for this kind of funding? Once you've got an idea of where the money might come from, you can then tailor your pitch to those particular sources of funding. As you engage with them, you need to determine whether or not you should have an NDA in place with them. Generally speaking, VCs, early stage VCs, won't sign an NDA. You should not be sharing your secret sauce, whatever that may be, with them, unless and until there is some obligation of confidentiality. That might come through an NDA, or it might just come through the business interaction that you have with them. And depending on whether they're a registered fund or not, they may have obligations of confidentiality that they owe to you. In any event, you want to make sure that the secret sauce doesn't get spilled, because once it's spilled, your value diminishes. Keep that secret sauce secret to the extent possible. Then you can have more open discussions with those funding partners or potential funding partners. As you move through the process, and there are lots of dating analogies that I'm not going to draw on today, but there needs to be an attraction. There needs to be a reason for a funder to continue the conversation. So it's not just peak interest, but actual continued interest. They want to dig deeper. They want to jump on the idea that you've got and see how you can develop that and create value. The first thing that's really going to come after an NDA is a term sheet. And it's okay to say to a potential funder, how long from our first meeting to a term sheet, so that you understand what their process is. Each of your potential funders will have a different process. They'll have a different internal process and a different process for engaging with potential investment opportunities. Chris, is it fair to say, and I know you've got a bunch of canned questions, and I'm going to flip it around so that you're answering some questions too. Is it fair to say that different VCs will have a different timeline depending on what their fund structure looks like?
Absolutely, and I think this is the, understanding the process is the one comment I would make is do your homework, right? And I remember being in some of your shoes as an entrepreneur in a startup and figuring out, I got to go raise some money. Well, where do I go? And it took a while to actually gather that information, but I was very thorough, used the network, talked to Chris, my accountants, other people, mentors, and just really understanding exactly what type of money I'm going to look to go and go after. And then each one of those were very unique. And that's what I didn't realize at first, was that each venture group, and Chris mentioned the angels and some friends and family, even understanding the expectations of friends and family. I've had situations where if those are not set and clearly communicated up front, things can go awry very quickly, whether it's 6 months down the road, they're thinking they're going to get their money back, double their money. So absolutely, Chris, you need to set these clear expectations, need to understand how these VCs, we're not chasing private equity money here. That's for much larger transactions. But absolutely, they all have a different process and how they think. So ask questions. But before you ask those questions, do your homework. Understand what their mandate is, what's their thesis, what's their typical check size. As a former venture capitalist, I can't count the number of times that I had startups and entrepreneurs come to me that had no relationship, first of all, with me and with the firm, nor did they actually even spend 2 minutes on our website to look at what our mandate or what our thesis is. So highly recommend doing your homework and educate yourself as much as you can. On that reference, Chris, I would actually reference a book called Venture Deals. Kelly and Dana it's by Brad, and I just can't recall Brad's last name, but we'll follow up there. I highly recommend reading that book. It was a book that I got referred to read almost a decade ago. So we'll definitely highlight, yes, Brad Feld. Thank you. Look at that. We got some entrepreneurs that are throwing it out there. So highly recommend the book, but do your homework with the venture groups and the investors you're going after.
So term sheet, due diligence, and that'll be business due diligence, legal due diligence, intellectual property due diligence, and that can take some time. So you need to build a calendar around that. Definitive agreements. It's probably going to be a safe agreement or some kind of convertible or straight equity. You need to think about what kind of equity or investment you're willing to take in and what that might look like for down the road. So always be thinking with a view to your best case scenario and your worst case scenario and what that looks like. Don't be giving up security if you can at all help it. Don't be taking loans. Your safe is probably your best bet until the value is actually better ascertainable, and we'll talk about price next. And once those definitive documents are negotiated and settled, you can move to close. That's not the end of it though, because chances are, especially early stage VCs are going to want a board seat. You're going to need to talk about governance issues. You're going to need to talk about disclosure and what your business operations look like on an ongoing basis. So you don't just cash the check and go back to work. It's actually the start of a relationship, and you need to think about what that relationship looks like over the entire course of that process. And again, we'll get into performance later on down the road. It's good for you to be thinking about what you're selling and at what price you're going to sell it at. So not just what kind of equity, but at what price. How do you value your idea, your business? I'm assuming you're incorporated already. If you're not, you should be. What that looks like. And so price and valuation is really, everybody focuses on it, but at a very early stage, your valuation, I think, is less important than all of the other P's. So price matters, but it also matters on the matrix between price and performance. So your value lift and the value lift that that VC or that investor is looking for is critical. I would rather, and I encourage clients all the time, take a bit of a haircut on your initial valuation and give yourself some room for success. That way your investor's happy. You will ultimately see, whether it's a year or two down the road, a lift. And you don't want to undersell yourself, but you don't want to oversell yourself and blow up the deal either. Chris is smiling, so he's got something to say.
No, I've got a question for you.
Sure.
So should the pitch include the valuation?
Absolutely not. Absolutely not. Chris is asking a great question. We just had a term sheet signed up for a client, medtech client, great financing opportunity. Unfortunately, in their very first corporate presentation, they had pinned their valuation, and the investor stuck them to that. There was zero flexibility around that.
But what about the ESOP plan? But that didn't include the ESOP. So can't we go back to the table?
Well, let's talk about price. So your price is can be measured in a number of different ways. How you value the company matters. What's included, what's excluded, what that value is attributable to matters. And so in this particular hypothetical case, the price that was indicated was for all of the common equity. It did not include the fully diluted calculation, taking into account a more than typical, more than generous ESOP. And so once you had factored in, that meant an additional piece of dilution of somewhere between 18 and 22%. So if the offer was $2 a share, it was now actually something more like $1.60 or $1.70. And that affects your economics, it affects your returns, and it affects the negotiation. So you better be clear about what price you're expecting, but know that you're going to get ground down on that price through negotiation. It's not the VC's job to make you feel good about yourself and give you a high valuation, although it does happen. Aware of another client circumstance in the last year where there was zero negotiation on price. The deal was so hot that it just flew off the shelf. Flexible on all other terms, accepted the price, no real negotiation. That is a unique circumstance that rarely happens. You should be prepared for negotiation on price. You should be prepared to be flexible. And frankly, if you're truly early stage and you're just incorporating, you've just got an idea, the only way to value that idea is what somebody's willing to pay for it. And so you can push back and you can negotiate, but price isn't something that I get too hung up on. I know every entrepreneur gets hung up on it, but I would rather see you have flexibility on governance issues. I would rather see you have flexibility on reporting issues so that you're not wasting your time doing a bunch of useless accounting that actually isn't meaningful to the investor at the end of the day. And give yourself a little bit of flexibility on price so that you can actually, exceed expectations when it comes to return. Anything else on price, Chris?
No, I think that's some key
Okay.
points.
Do we have any questions coming in online? So through the chat function, I'd encourage everyone, if you do have questions as we kind of move through the presentation here, to lob those in. We'll try and deal with them on the fly. Chris's canned questions are decent, but I'm sure yours are better. So we've talked about process, we've talked about price. I want to talk about practice. And practice really means, how organized are you? What is your business practice? What does that look like? If you're a first-time entrepreneur, do you know what you're doing? Do you have an accounting system set up? Can you even account for the money that you're hoping to bring in through investment? Are you keeping track of your expenses? I'm just dealing with a client now who graduated from our startup program a couple of years ago. Very innovative, really a game-changing tool company. And you know, it was a shoebox full of receipts for the founder's expenses. And CFOs now got to go dig through that shoebox, figure out how to deal with all those expenses. We've gone through a couple of years of accounting. We're going through an audit now. It's hard. And so you need to actually have a practice that allows you to give the reporting you need, but also to have confidence that when you're doing things like grant applications, tax credit applications, you can rely on the business practice. That business practice should not be all that hard or cumbersome. It just means you need to be organized so that you can give confidence to the early stage VCs, your investors, that once they write a check, you're not going to lose it before you even cash it. That once you do cash it, you're able to account for it. And that as you're running your business, you're running it in not the most efficient way possible, not the most organized way possible, but a reasonable way that they have some confidence that you're running your business with their money in a reasonable way. The last P that I'm not going to talk about is perfection, because it doesn't exist. Imperfection is everywhere. That's life. Nothing is perfect. There's no accounting system that's perfect. There's no accountant that's perfect. There's no CEO. There's no founder that's perfect.
There's no skeletons.
There are always skeletons. Halloween's coming up. You'll see lots of bones scattered amongst, like around the city. You're going to have skeletons. Even for a company that was incorporated yesterday, nothing's perfect. Those are the kinds of things that should be disclosed early on. So if there are problems, again, dealing with another startup client now, they've been around for a couple of years, they're generating some revenue, kind of forgot to incorporate in the US. And so you've been running your business, you're collecting revenue, you've got income, you've got employees, and that has a bunch of tax implications. It's way easier to get those things set up at the outset than it is to clean them up on the way out, or once the issue's been realized. So just be thoughtful. Ask your advisors, hey, is there a tax structure that works here? And you might be afraid to call on those advisors because they're expensive, because their hourly rate is too high, but it's cheap insurance. And you're going to save yourself a lot of money in the long run by asking the right questions at the right time.
So I've never had skeletons in any of my startups, as Chris knows. 11th hour closing. What's this? What's this insurance claim that hasn't been closed? And what do you mean the venture capitalist does not want to deal with this? And it's the unexpected. So Chris spoke about just be honest and upfront. And I think that's the biggest thing that I would say is sitting in the entrepreneur's shoes is it's never perfect. It never will be. But that honesty and upfront communication is absolutely critical at every part of the deal. So, if you do have some skeletons that you're working through a process to clean up, whether it's an unhappy shareholder or there's a key employee that is actually not going to stick around after the deal closes, be upfront with the investors of that situation and work together. They want to be fair and reasonable. be upfront, be honest. But I just speak, we almost lost that deal. I remember that.
Yep, we did.
But we got the deal done. And it was something that I knew about 12 months before the closing. We were trying to deal with it, but there was other things. We were fundraising and lots of pieces of the puzzle coming together. And at the 11th hour, we were about to sign the agreement with the venture capital group. And we, I think, spent most of the day dealing with that issue, but we got the deal done. So just life lessons again, some of the business scars I have, I guess, and experience, but highly recommend just being upfront and honest with these potential investors.
One of my longest standing clients likes to say, the thing you least want to talk about is the thing you should most disclose. And so to your point about skeletons, you don't know what's going to be important to your investor, which is why you actually have to go out of your way to talk about those pinch points, those pain points, those potential problems, because they may not be a problem at the end of the day. That's your best case scenario. Your worst case scenario is you take the money, you cash the check, and that problem becomes a gigantic headache for everyone. Your investor will feel like you've been less than truthful, less than forthright. That's not great. It will make them doubt your business ethics and acumen. And so to the extent you can be open and honest about these things, how you represent those potential problems is important. But you have to be honest and forthright, which is common sense, but really goes against the entrepreneurial instinct to assume that you can solve every problem easily and without fuss. And that's just impossible. Things become problems. Things are not within your control. Everything takes longer than you think it's going to and costs more. And so before it really costs a lot in terms of your credibility, which is the most important thing, and money, you need to bring those things to light. So going back to process, you sign a term sheet, the investor is going to be doing some due diligence. That's the point at which you raise those issues. It's not before they sign a term sheet. It's not in your pitch where you say, yeah, well, the guy who created this software, our best developer is leaving to join a competitor. You need to think about how you're going to address those issues. And you need to solve that problem before it becomes a problem. You can't just drop a problem on the table. You need to say, this is going to be a problem, and here's how we're going to solve it. So to the extent you can bring solutions to the problem, all the better. And you should be organized in your due diligence. So you should have a data site. Dropbox is fine, but you really should have a secure data site that's kind of password access, different levels for different stages of the process as you move through, that allows you to share information with potential investors and has some level of confidentiality built into it. So that's practice.
Sorry, so just
you've got some questions?
Yeah, maybe. The question or the statement is, would you suggest having top 5 reasons why not to invest in us in a second or third meeting investors pitch deck?
No.
Yeah.
You can use that as a tool, but giving someone a reason not to invest is not a great way to get them to invest, in my mind. I'm not a sales guy, but I do think that although you can draw light or shed light on the pros and cons of an investment, focusing on the con is not a great way to get to the pro.
Yeah, and again, this is the wonderful journey as being an entrepreneur and raising money. This is the toughest thing you'll ever do, the hardest thing you'll ever do in your life. And I think Chris knows this, that when I first went out to do my friends and family round, first time ever raising money, I had 85 no's. 85. I still actually have the book on my bookcase at home because I was about to, that's it, I'm done. And it was literally that 86th meeting that I landed a check for $500,000. And I don't even think I think I had my pitch deck, I bet probably started at 25, but it took a lot of, real learning to just real life experience to get it down to that 10 slides. But I remember going into the meeting and I don't even think I opened it. I just had everything in my head. It just rolled off my tongue and I walked away with a $500,000 check. So in that, I felt, what did I learn from that situation? I actually came into that meeting with a ton of confidence, and I knew how good this opportunity was for this individual, and I knew that we were going to make him money. And I also, the presentation and the business plan was very positive, right? So I think focusing on something that is negative, it's like we do every day. We put negative thoughts in our head, we're going to have a bad day, right? But we get up every morning, we think of how grateful we are to be where we are and do what we're doing. I think that's it's the positive thinking that creates a positive outcome.
I think that's generally true. Sophisticated investors will be able to have their own list of cons. You should provide them with the pros. If you want to add in, again, critical elements, okay to do that. Especially if there is a competitive landscape where you're just trying to do something better or cheaper than someone else. But at the end of the day, your job is to sell yourself and your idea and your company, not give someone a reason not to invest. So just like in the sports world, positive coaching generally works better than the negative. And the rule is usually 3 to 1, 3 compliments for every critical piece of information.
I'm going to be the next Google.
You might be the next Google. And good luck to you.
Yeah.
But Google started somewhere.
Yes.
Everybody starts somewhere.
Yes.
And you can't start with, here are 5 reasons not to do this. You need 5 reasons to do it, and one that says, here's a reason that we have some concern about these 5 great reasons to do it. So that brings me to my next P, which is people. And you have to have the right people in your team that not only complement you and some of your weaknesses, fill in the gaps, but also identify where those gaps are, where you need help, because sometimes your investors, through their network, will be able to help you fill those gaps. Some people call them holes. I don't like calling them holes because they're just gaps. Again, nothing's perfect. Hole just never ends. It can be shallow or deep. You just don't know. But a gap you can bridge and still keep walking the path. So you need the right people on your team. You should have good leadership. And lots of entrepreneurs aren't great leaders. They're great idea people. They're great engineers, great software folks. At some point down the process, you may think about bringing in a professional CEO to run the business of the business that allows you to keep doing what you do best. There are great governance folks. You don't really need that much governance when you're a startup. You don't need to put those elements in place just yet. You need to be mindful of them. Good to have them. Don't get stuck on them. We've had meetings with startup clients where they're, talking about really sophisticated elements of a shareholder agreement. It doesn't matter if you're not making any money. Go make some money, and then we'll worry about how to divvy it up. And if there's nothing to fight over, well, your shareholder agreement doesn't matter that much. So take something that's off the shelf, efficient, get started, and then worry about it later. You can always tweak things as you move through the piece. Similarly, so leadership, finance, which is critical and can be part-time right out of the gate. You don't need a CFO. You don't need a controller even, unless you do have some money coming in. When you're in a development phase, it's more important that your dev team or whatever it is, whoever it is you're working with, is well looked after, properly incentivized, and that's the other aspect of people.
So might as well jump in with a question here. Sorry to interrupt, Chris. Are there unique challenges in raising capital here in Alberta versus other markets? If so, What are they, and how did you address them? It's a good question. I love that.
It's a great question. And if we had good answers for that, we wouldn't be where we are. And this is personal view. I think the biggest gap is between the wealth we have in this province and the talent. And a lot of the wealth is resource derived, and the talent, which needs some of that wealth to be shared and distributed in order to advance innovation. That's where the gap is that I see, and the risk profile is different. So the wealth needs to understand the potential returns in order to be able to share the risk of that innovation. So that's my view. And I think, we're in a process at a macro level where that's changing. I think some of the things that Alberta Innovates and some of the kind of local economic development agencies are doing are important and can be refined, but we really need folks. We need some success stories that will allow those investors and that money to see the potential returns. And that's starting to happen. Success begets success. So the more success stories we have, the more money will flow and the more investment there will be.
Yeah, and I guess, are there challenges? Absolutely. Is it a different market? Absolutely. I was very fortunate, again, to travel across North America and see the angel network in North America and specifically down south, and how different how they interact and look at deals and where the deal flow comes from. And then here in Alberta, as Chris mentioned, with the energy base and what's happened here across the globe in the energy market, it has affected the way people are making investments. But I'd have to say that as an entrepreneur and somebody that's got a startup, there is some fundamental things here for your business that you need to focus on before you go to the market, so that when you do get a door opened or you have an opportunity to build a relationship, that you walk in and you have that initial interest from the angel or even friends and family. I mean, just because it's friends and family doesn't mean they're going to invest. They have to believe in you. They have to trust. They have to believe that there's an opportunity. And obviously they're looking for a return on their investment. So I think here in Alberta, I think it's even more important that as you're starting a startup or you're thinking about a business, you're actually starting to network. And I know that's actually, I'd say it's actually even a little bit easier right now to network over Zoom and on, I think more people are apt to actually networking without having to take that time to drive to a coffee shop or meet at the office or wherever you are. So I think actually before you're actually even considering raising money, that you need to start to build that network. And for a lot of entrepreneurs and startups, that's a hard thing to learn how to do and how to network. And again, there's tools through a lot of the Alberta Innovates programs. There's programs here in Calgary, up in Edmonton, obviously this week, fantastic opportunity with Startup Edmonton and the programming they're doing. The more you can educate yourself, and that's why, again, I don't know everything. I'm a life learner and I learn things every day, and I'm willing to challenge myself on that. So understand, yes, this is a tough market right now, but if you really do have the structure and the fundamentals in place, and you actually have a product that is actually being bought by customers, and there's validation, and there's a pilot, there's some betas. I mean, that's the interest, that's the level you need, and the traction, the validation that this is actually a service or a product that is needed, and people are willing to pay for that.
That's a good point. And it goes to our next P, which is performance. So you're going to make some representations to your investors about where you're at right now and where you want to be, how you're going to use that capital to accelerate growth or develop a product. And you need to be very careful about what you're promising. So in your pitch deck, in your discussions with that investor, you need to say, here's where we're at, here's the team, we've got these gaps, we need to fill them. Here's where we want to be in 6 months, 12 months, 24 months. And as you network and as you raise that money, you need to be realistic about your performance. As I said, everything takes longer than you think it's going to. everything costs more than you think it's going to. There's going to be unexpected occurrences that you simply can't predict, and you need to be able to deal with that. If nothing else, 2020's takeaway is things happen that no one could have predicted, and it has a fundamental impact on your business, on your people, on your process, on your price, on your practice, and on your performance. And so you should always understate and over deliver. So if your investment comes with milestones attached to it before you're able to unlock the next level of funding, make sure those milestones are achievable. Don't set them so high that you can't possibly get there in the time and with the quality of product as promised, or you will fail. Failing, people love to say,
Pivot.
well, you can pivot. I don't like to fail. I don't like to lose. And so failure you can learn from, but it's still not great. It's not winning. Winning is way better than failing. And so set yourself up for success, not for failure. That would be my kind of best advice when it comes to performance. Your investors will appreciate your honesty. They will appreciate the performance. They will appreciate, hopefully, the profit and everything else that comes with that. So as you move through the process, you need to understand that communicating your performance, not in a braggartly way, but really celebrating your success is important, that your investor is aware of your success. They're more likely to have some kind of follow-on investment if they see that that progress.
So question, might as well take this inbound here. So what are investors looking for in a business plan or a pitch deck of a startup, and what elements can reduce the chances of investment?
It's impossible to answer this question in one sentence or one paragraph, because each investor is looking for something different. So there's no one size fits all solution. I think in a pitch deck, what most early stage investors are looking for is a clear enunciation of the concept and the potential. You need to let them run the math on what the potential is. And you need to kind of paint the picture, 1 + 1 =, and then a question mark. That's the potential piece. The product piece is up to you. The concept piece, a clear explanation of that. And although Chris likes 10 slides,
12, maybe.
12?
10 to 12.
My CV has never been more than 1 page. The font gets really small at a certain point, but I like brevity. I lose interest and I get bored after a couple of pages. And so unless you're actually sitting down either over Zoom or in person and going through a pitch deck, in the first couple of pages, I should know who you are, what you're doing, and where you're headed, and how much money you need to do it. That's it. If it is a complicated, software process or product, you can get into some of the detail later on. But really in the first couple of pages, I think you should be giving potential investors a really good sense. Don't waste the first couple of pages on your legal disclaimers. Don't waste it other than the cover page on your logo. Put the people and the team at the back and tell people what you're doing. Is that fair?
Yeah. What's the problem and what's the solution, right? And again, I'd also say this was an interesting scenario that I had and have had many times throughout my career, but my young daughter, and you have young daughters, ask them to explain what your company does. And if they can explain it back to you in 30 seconds or less, you've nailed it. And I absolutely, it's something I started doing years ago, because my daughter, my wife would ask, well, what do you think Dad does for work? He goes for coffee. And that was right. That was all she thought I did, is I just traveled around downtown and met with all these people and traveled on planes. But I went for coffee. That was my job. So not a bad job, I guess.
So you're giving her pitch decks of potential investee companies.
Yeah.
And did you pay her?
No.
No.
So she was my analyst. But no, it was a great process to go through, and you know, just less is more. I can't say this enough. Less is more. And I have had so many different conversations with some of the most talented and wise and knowledgeable people in the world, in the globe, down in the valley. And you start talking to them and you actually can't understand exactly what it is, the problem, and how they're trying to solve that problem. They get so complex and they get so detailed.
So the worst deck I've ever seen was a bunch of former NASA rocket scientists who wanted to put solar panels in space and then on satellites and beam the energy back down to Earth with giant lasers, and then have a catchment at the bottom. And their IRR after 30 years, and they put this in the deck, was -9%. It was a $50 billion project.
I'll invest.
I was like, what, why? Like, why would anyone do this? And it was like 30 pages long, terribly complicated. There's a lot of bright folks in you know, the rocket science industry. You need to be able to explain it to a 10-year-old and have them explain it back, because otherwise folks will lose interest. It's hard to understand. And life's not that complicated, actually. Rocket surgery is not that hard. So you can figure that out. And if you have the folks who can't get to that level of generality and explain what you're doing in very simple terms, they might not be the right folks to run your business.
Right, right. So another question just came in here. Can you talk a bit more about investor fit alignment? For example, are there times when you should not take a check? Personal stories about this. Oh, this gets me fired up. Yes, absolutely. There is always times not to take that check. And again, maybe I've simplified this. Vet your potential partners or your investors like you would vet, not vet's maybe not the right word. You would date your spouse or date somebody, get into a relationship, a long-term relationship. I honestly, I can't say this enough, but that process of dating, and I've been married now for 21 years and together for 25. So
in other words, Chris doesn't date.
I don't date.
Know what he's talking about.
Yeah. But when it comes down to the investors and that alignment, and again, that is that open, honest conversation with the investor, with the family office, with the angels. What are they looking for? So obviously you can tell Chris and I love to talk. We can talk forever. One of the things I needed to do as an entrepreneur and as a startup was to listen more, but ask questions and listen more. And actually, you know, yes, there's the active listening, and what I'm hearing you say is, and you don't need to take it to that extreme, but I do think it's so important for you to understand and ask those questions so that you do have true alignment. And the more you understand, even going into the meeting, you know, how to ask those questions because you've done your homework on those investors, that's going to set you up for more success. And you know what? The other thing I'd say is go with your gut.
So my view is that the best way to, once you've done kind of a pre-sort and you have identified the money sources, you're engaging with those folks. One of the best ways to actually determine fit and function of that VC or that investor is to ask for referrals. So ask for a referral to the CEO of another company they've invested in. So you can go and have coffee with them or chat with them and find out what are they like after the check gets cut. Once you've closed that financing, how are they on the board? Do they actually participate, or are they there to criticize? Are they engaging you with other potential partners? Are they helping you? Are they helping to fill some of those gaps? Or are they really reserved? They wrote the check, they're just there to observe, they're not participating, and they're gonna let you succeed or fail on your own. So that fit and function, you can check. To use, I told you we weren't going to use the dating analogy, but it's like, it's like going to talk to someone's ex.
Right.
What about this? What about this? You know, when they do that annoying thing when they pick at their teeth, can you get over that? Right. So it is a vetting process. There's due diligence that they will do on you on the legal side, on the business side, but you can do your own due diligence to ensure that that fit actually is going to work. And when you should walk away from a check is when you have options. So don't walk away from the check just because you don't like the fit. If that's your only option, that's the deal you're doing. And you can try and make it better, but that's the deal you're doing. If you have options, you should be making sure that that fit is almost primary, because you're going to have a real relationship with those folks over time, which means not just cashing the check, but once you've cashed the check, engage with them socially, have dinner with them, get to know them, because when things get tough, you need to call on those relationships and you need them to help you.
Absolutely. So a couple more questions here, Chris. You might want to talk about the importance of nailing down IP rights as early as possible before money becomes a part of the discussion with key people.
So this is easy. Absolutely everyone in the organization, whether contractor, consultant, employee, founder, needs to give up all their rights. Whether that's in exchange for equity or a consulting arrangement or options, the company itself needs to hold the most valuable commodity, which is the IP. And I'm just using for example, but that if there's a patent in play, whether it's trademarks, whether it's trade secrets, whatever that intellectual property is most valuable in the company. You cannot have any leakage. To the extent there is leakage, you need to deal with it early, so that you can answer honestly the due diligence question, which will come from potential investors, which is this locked down? You need to be able to say, yeah, it's locked down. There's no leakage, and we've got everybody.
Yeah, great answer. So Dana, we've got about 5 minutes left in the session here. Don't know if there's any other questions coming in here. Sorry, I'm just unmuting Dana.
Thanks. I was stuck in timeout. No, if there are no more questions, we can carry on, let everyone go on with the rest of their startup week. We will be sharing our contact information in the chat. Kelly will share mine, and I think both Chris's. Chris, will you and Chris be sharing your information?
Just
Crispy.
Yeah, I can help facilitate any intros to Chris.
Sure. So if you want information about Alberta Innovates, our executive business advisors, of which Chris is one, connect with me. And then if you'd like a connection to Fasken, please connect with Chris Buckman. And I see our information is in the side there. So
Dana, just in closing, Dana, obviously I work closely, and Dana's our director in our group. Dana, and Chris, Dana, I'll throw it to you. Any closing comments that we might have, again, this was a snapshot of some key points. Obviously there's a lot more to unpack and discuss here. So, look forward to connecting with some of you, but Dana, any other comments in closing?
So my one thing I would add is find somebody who's done it before. Like, that is why we created this program. Don't do it yourself and find out your mistakes after you make them. There are people that can walk you through the process, and it doesn't have to be one of us. There's a lot of advisors out there, but find someone who's done it before. Don't go blind, because you always find out the hard stuff and the stuff that you should have done later. And, other people can help you prevent a lot of that as you go if they've done it before. A term sheet is it's not a really difficult instrument if you've done it one time, right? You start to understand how it works. And again, venture deals, they're actually doing free training right now. So it's an 8-week course. I'm doing it. It's very helpful. It's 3 to 4 hours of work a week, but it gives you such an in-depth understanding of the term sheet that if you are preparing to send one out, I would absolutely sign up and do that, because I found it to be incredibly helpful. But yeah, that's it for me. Just find someone else who's been there, done that.
Thank you, Dana.
No, I think I've said enough.
Have you? Yeah. Well, thank you everyone for joining us. As you can tell, we could talk forever, but we want to keep everybody on schedule. And Dana, thanks so much for having us. The opportunity for us to speak to
This is great.
Yeah, thank you.
Thank you everybody for coming.